All right. Hello, everybody. Thanks for coming to our first live Facebook Live event. The Reynolds Home Team, our Lunchin Roundtable. We're here with what? Okay. I'm being told to be quieter. I've never had that problem before. So we're here with Philip with Movement Mortgage. Philip, what we wanted to do is try and have an avenue to get some up-to-date information out to you as soon as possible as market is making changes. And so one of our first stops is going to be our lender in the home buying process or investing process. And so we thought it was apt to bring Philip, so thanks for coming.
Appreciate the opportunity to be here.
Thank you. So first off, want to ask everybody if you are on live, if you'll share it, if you'll like our Facebook page as well as Movement Mortgage. We really appreciate that. It helps to drive it out to your friends as well, and so that they can get this updated information as well. So first off, I wanted to have Philip just tell me a little bit about yourself and the audience and what exactly a loan originator does.
Sure. Well, loan originator, basically, if you look at our company's definition of what our founder says he wants loan officers to do, is build relationships, find loans, and determine if we have a loan or not. And then we've built a very large team of support to help us go capture all the documents from the borrower. The loan officer stays actively involved throughout the process, notifies the real estate agents, notifies the borrower as things are progressing along in the process itself.
Great. Well, so, one of the things that we want to make sure we're doing with these videos is that we're bringing you up-to-date information. And one of the things, if you've noticed, you've been watching the markets, there's been a lot of fluctuation with the election and after that in the market as well as in with the Fed. Recently rates were raised, and so the big question that everyone's asking or should be asking is what exactly is going on with rates, and how can some people protect themselves in those situations from those heightened rates?
Sure. Well, first off, what we saw happen really started in October. August, September, we saw some of the lowest rates we've seen in years. Everybody started getting comfortable, think rates were going to stay the same. Obviously, as we all know, we had a fairly significant surprise at the election. When I went to bed at 4 in the morning, it looked like it was going to be a great opportunity for refinancing. Wall Street said, hey, this is a really good thing that the Republicans own all branches of the government, from the Congress to the White House to the Senate and so forth. And so when we walked in, the bond market was falling and the stock market was increasing. Thus, interest rates were rising. And so we went about 2 weeks of seeing significant changes in the interest rate, probably as much as half to 3/4 in the rate. Everybody is expecting the Fed announcement last Wednesday, anticipating they were going to announce raising of the interest rates. All the indicators were out there were going to do that. However, they surprised the market, indicating that they're also going to reduce their holdings on mortgage-backed securities and anticipate raising rates in 2017. The result of that, we lost another 1/4 in rate. So really from October to where we're at today, we've lost about 1 percentage point in rate, which has a significant impact on a borrower's purchasing power. Candidly, the only way to protect themselves from the interest rate changes is to go get under contract to find a house. There's very, very few lenders that offer a lock program if you don't have a house. If you're new construction, there is a concept of an extended lock program. You can lock up to 1 year. We're one of the lenders that offer that.
Wow.
So that's a great opportunity to protect yourself. Obviously, if rates fall back down, there is what they call a float down policy that different lenders have that won't get you back to the exact number where we're at that point in time, but an opportunity to maybe regain some of it with the insurance policy you bought with the extended lock program.
So we know that there's a lot of folks that have been sitting on the fence, trying to see what's going on, and the holidays are here, and happy holidays, everyone. But what's the problem with waiting? So we've lost a point, right? So what does that mean?
Well, so from a dollar perspective, basically every eighth in rate comes out to about $7-8 per month on $100,000. So if you're looking at $250,000-$300,000 and you've lost $24 times 8, you're about $180 more expensive with your monthly payment if you're putting like a 5% down payment down and so forth. So what's going to happen in the future? If I knew that, probably wouldn't be here today. I'd probably be sitting
Get that
home
crystal ball.
and betting on the market and so forth. But the projections are they're going to continue going up. So people who continually sit on the fence potentially are risking seeing rates go further and further up. I know people I respect in the industry don't see rates falling back down to where we were in the 3% range. They think we're the 4% is where we're going to be, and potentially go into the 5% over 2017. So if you're out there thinking about buying, thinking about selling, sooner versus later is going to be your better alternative.
So obviously that's going to affect people who are buyers who are even already pre-qualified, right?
Yeah.
Potentially.
Yep. If you've been pre-qualified and the lender has pre-qualified you up to your maximum loan amount and assumed a low interest rate, you may not be able to be qualified for the amount that you've already been approved. If you're in new construction and you're already under contract, again, if your ratios are very high, you actually may not be able to qualify for the purchase of that house. So you really need to get with your lender, figure out if you're still good at the price points that you've already been approved at.
So as far as takeaways or action items, I mean, if we've got folks out there who are looking to sell, this means we're still in a seller's market. We've still got low inventory. We've still got the opportunity there. You've still got a lot of buyers coming into the market. That's a nice part about being in Texas. We're business friendly, a lot of people moving here. But that also means what we're just talking about is that the buyer pool is shrinking. So the higher priced houses are sitting for a little bit longer, and we may see that start to sit longer as far as days on market, as it moves down market as well as these rates continue to climb. So the time is now to take action if you are considering that whatsoever. And so reach out to us or to Philip, and we can help you with that. So next question that comes up pretty often with prospective buyers is really, when should we start the process with you?
Well, my general opinion is you should start as soon as possible. We want to make sure that there's not things on your credit report that you're unaware of. I take lots of applications, and people are shocked to find that they have a medical collection or medical collections
Right.
they're unaware of that has dramatically affected their credit scores. So it's an opportunity for people to get a sense of what their credit scores are and potentially get some of those things addressed and get their credit scores higher. Also, we find people who think they can qualify, but due to the guideline issues, maybe they're getting variable income, maybe they're self-employed but only been self-employed for less than 2 years. Although there's ways around that, we really want to get an understanding of what their financial picture looks like at that point in time and give them some advice. For a self-employed borrower who's taking advantage of all the tax write-offs that the IRS allows for, you may have to take a few less tax write-offs to increase your income as well as qualify. So this is a great time to be talking to a lender, to verify their credit and also their income.
Okay. Well, so takeaway from that should be as well that, it's always a good idea to check your credit. You can do that free every year from the 3 different bureaus. And so take a look at your credit and make sure you understand what is actually on your credit. Why is it that you sometimes see a negative event showing up maybe on TransUnion but not on Equifax? Or
Sure. Well, I think there's a couple of valid points. So the free credit services that you can go look at sometimes can give you a false sense of security. That's a generic consumer credit score. It's not specific to the type of credit you're applying for. So if you were to go out today and have your credit pulled for a car loan or a mortgage and a credit card, you're going to get 3 different sets of scores. And so it's really important not to presume that what you're getting as your free credit report is actually your credit score. So it certainly should tell you if there's negative things on your credit report, what are those things on the credit report. Why you might see different scores, there's really 2 different reasons. One, each one of the credit bureaus have their own algorithm. They're updating those, they calculate based upon the risk that they're looking at and so forth. The other reason is not all creditors report your credit to all 3 bureaus. So you may have a negative event that's being reported to only one, which would be a good thing, but you may have positive credit that's not being reported to one, and therefore that credit score won't be as high either.
well, do you have some examples or some specific stories you can tell about folks they found something on their credit and how quickly they've been able to get that addressed or removed?
Sure. One of my favorite stories, I had a young lady who had a $28 medical collection that she believed that she had taken care of a couple years earlier, but it was still being reported on her credit report. And I said, hey, you need to contact them. The medical collection companies, you generally can get them to remove it if you pay them. There's specific things advice that they can follow to get that removed. She was somewhat obstinate and says, well, I don't want to pay it again. I've already paid it for $28. You've already approved me. Why would I want to do that? I said, I'm trying to save you money by getting that removed. Well, she did take the advice. She got it removed, and her credit score went up 110 points. So wow. She went from being in a government loan to a conventional loan with dramatically lower interest rates.
That's awesome. That's awesome. Well, so moving to the next step, after we go through kind of the initial process of looking at, where are they at, and what's their debt to income, look at, when you actually go through the official process, tell me what the difference is, because this comes up all the time, even with realtors. What's the difference between pre-qualification and pre-approval, and why would you want one versus another?
Well, it's an interesting question because pre-qualification and pre-approval mean different things to different people. I would say the majority of the people in the industry using old terminology, and we'll talk about the state's rules, a pre-qualification generally meant that the loan officer had an interview with the client and pulled their credit, but hasn't received any of their supporting documents. They didn't get their pay stubs, haven't received their bank statements, and so forth. And without the documentations, it's basically garbage in is garbage out. Right. There could be something on your pay stub that the borrower forgot to tell us, for example, child support payment. Or they're calculating their income and they're calculating all of their overtime income, and they just started collecting overtime in the last 6 months. A pre-approval typically means to most people that the lender has received all of the supporting documents and have confirmed the information that the borrower had provided. It's a much stronger way of confirming their ability to purchase a home.
Right, great. Well, so we'll kind of get into that a little bit again here when we talk about the actual process that we go through as far as the entire transaction and why it's so important to have a realtor as well as your mortgage professional who's going to help you walk through each of those steps. But one of the questions that I got submitted to me the other day was in regards to the actual lender and what is the process that you go through? What makes y'all different as far as Movement Mortgage?
Sure. Well, Movement Mortgage is one of the few lenders in the country that actually will underwrite a file in advance of ever finding a home. So generally speaking, probably with a 99% probability, after going through underwriting, we will be able to say that this borrower has been underwritten approved. It makes your offer a dramatically stronger offer when you talk to the listing agent and let them know that. It also provides us the ability, combined with our unique process, for the ability to close much faster than other lenders. We've closed 2 loans this month in 10 days, for example, where most lenders are looking for 30 days. So what we try to do for our clients is provide them a competitive advantage of having their offer accepted. It's why we're the fastest growing lender in the United States right now.
That's great. Well, we can personally testify to that with Philip and give him props. We recently closed a deal where we had 11 different offers. He was one of the only lenders that reached out proactively to the seller agent. So depending on which side of the transaction that we're on, whether we're representing the buyer or representing the seller, it's exceedingly important to me when I'm sitting on the seller side to get that call.
Sure.
And to understand which buyer can actually get to the closing table, because that's what we're trying to determine as we sift through these offers. They may be within just a few dollars, or there may be massive differences, but even if one is $10,000 above the other and they can't get to the closing table, it really doesn't matter much. Right. And then on the buying side, we're still in a very competitive seller's market with inventory less than typically 30 days. So when you're competing against all these other buyers, and maybe you're in that process now and you've actually missed out on a couple of homes, there are some things that we do differently as getting to know our buyers and by using lenders who will take it to the next step. So one of the things that we haven't talked about is what is the one thing that Movement does that 99% of the other lenders don't do?
Yeah, it's the underwriting approval in advance. I mean, right. From the time I'll get the loan, we submit it directly to underwriting. We typically have an underwriting decision back in about 3 hours. Our company standard is 6 hours. And so the fact that we can say, hey, this borrower is good to go, we've received all the documents, we've pulled their credit, everything is great, it really distinguishes us differently from our competitors in the marketplace, which allows you to make a much stronger offer on behalf of your clients.
And is it accurate to say that when you've cleared, because a lot of people don't understand underwriting, what exactly that is, and overlays and all of those things, so that basically means that they've got a loan that's ready to go.
Yeah, we issue a commit to lend letter, so provided nothing changes in the borrower's credit profile, i.e. they don't go out and buy a refrigerator and things of that nature, It means we've effectively made the determination prior to them finding a property that we're going to lend to them X amount of dollars. Obviously, if you find the wrong property that has higher property taxes than we expect, it could affect the deal. But generally speaking, you're at a very high level of probability that we're going to be able to approve that property and approve that borrower and close quickly.
That's great. Well, so one of the other questions that comes up all the time when we're doing interviews is, well, what are all these different kinds of loans? So I know Movement does a ton of different types of loans, but can we, saying for the sake of time, since we got maybe about 9 minutes left here, can you just talk about what does conventional mean? FHA, VA, what do those main loans mean?
Well, conventional is a conforming loan supported by both Fannie Mae, Freddie Mac, two entities that basically are insuring the loans. It's what we typically just call a conventional loan. On the VA loans and the FHA loans, VA stands for Veteran Administration. So the VA provides loans to veterans. It's considered a government loan, as is FHA, Federal Housing Authority. Right. So in those cases, the government is basically backing those loans. They are typically more liberal than a conventional loan with respect to credit scores and debt-to-income ratios and so forth. So it minimizes the risk to the borrowers, or to the investors, that they're being supported by Fannie Mae and Freddie Mac and so forth. Versus Fannie Mae and Freddie Mac, the FHA and VA loans are being backed by the government at that point in time.
So why would our buyers choose one versus another?
Sure.
For most examples?
Typically, if the ratios are within the Freddie Mac and the Freddie Mac and Fannie Mae guidelines, and their debt-to-income ratios are not too high, then and their credit scores are very high, then they're going to be better off doing a conventional loan. Their overall cost of a mortgage will be lower. Their interest rate may be slightly higher, but their cost of mortgage insurance will be less. On a conventional loan, your mortgage insurance will stop. Basically, legally it has to stop when you hit 78% loan to value. Generally, it'll stop at 80% loan to value. On a FHA loan, the mortgage insurance doesn't generally stop unless you put 10% down. It's kind of an unknown fact that most people don't know. If it's an FHA loan, you put 10% down, it'll stop in the 11th year. On a VA loan, you don't have mortgage insurance per se. It's built into what they call the VA funding fee. But generally, if you have low credit scores or you're trying to buy a lot of house, then FHA is going to be your better option. If you're within ratios, you have high credit scores, then conventional is going to be your alternative, your better option there. FHA requires 3.5% down. If you're a first-time home buyer on a conventional, you can get into a house for just 3% down. Typically, if you've owned a home in the last 3 years, then you could go as low as 5% down.
Okay. Well, and I know that's a question we get, and so correct me if I say something wrong here, but mortgage insurance, that's something that a lot of people get confused about. What is mortgage insurance versus what is insurance on the home? They get those two sometimes mixed up. And yes, you have to have insurance on the home if you have a mortgage. That's the lender required.
Right.
They want to make sure it's not going to burn down or anything like that, and there's not coverage for that loan. So it's a risk mitigation thing for them. But mortgage insurance is actually added into the loan, and so tell us a little bit about that.
Sure. Mortgage insurance is to protect the investor from the borrower defaulting on the loan. Right. So the cost of your mortgage insurance is really defined by two things. One, what's your credit scores, and secondly, how much money you're putting down. So the higher the credit score, the more money down, the lower the cost of mortgage insurance is going to be. But it's designed to protect the investor from you defaulting on the loan.
Right. And so what we're looking at is if you're putting less than 20% down,
right,
you're going to be paying mortgage insurance in most cases.
Yes.
Okay. And so that's not something to be necessarily afraid of. Sometimes it works out better for you to actually pay that and put less money up front. Right. But as far as the life of the loan, if you can avoid it, you're probably going to be better off.
Right. On an FHA loan, it's defined at 0.85% unless you put more than 5% down. Then it's at 0.8%. On a conventional loan, the rate's going to change. It could be as low as 0.30% to could be up to 1.35% if you have really bad credit.
So one of the other questions that we got was, once the buyer and the contract has been approved, and this comes up quite frequently, what are some of the most common mistakes that people make? I think you've got a list that I've seen you send out before, the thou shalt nots.
Oh, sure. But we have a bunch of do's and don'ts. The big ones are really do not open additional credit. Everyone has a tendency to want to go out and buy the new furniture, the new appliances for the new home,
New house.
and for the new house, and where it could adversely affect their ability to purchase. So that we talked about earlier of being pre-approved or underwritten approved, and if you start adding additional debt to your credit profile, it may disqualify you from purchasing. So that's probably the number one thing they do. I think the second thing people don't do correctly is they want to sometimes argue over what documents we need, right? We try not to ask for things we don't need, right? So large deposits into bank accounts is a really bad thing, right? So those are probably the two big issues that get in the way of them.
So in the past, I know I've heard people say, well, I can't get a gift, I'm afraid to get a gift or take a gift. But that actually can work too, right?
Sure. Both all loan programs allow for gifts, typically from a family member, and the gifts are going to have to be sourced. The rules are slightly different for VA and FHA and conventional of what type of documentation we need. One of the things that's important is to make sure that the giver of the gift is willing to share their financial information with the lender. Some parents, some grandparents don't want to do that. And unfortunately, there's not a lot of room for negotiation there. Conventional, we need a lot less than we need an FHA loan. On an FHA loan, we need 2 months of bank statements.
We just had a question pop up.
All right.
This is from Hope Dean. She says, I'm retired.
Hey, Hope.
Hello, I'm retired, thinking of buying a duplex to have one mortgage, but wondering if this type of property is considered a commercial loan and harder to get instead of just buying a residential property.
Up to 4 units will be considered a primary residence. So you can buy that either as an investment property or you can buy it as your primary residence as long as you're going to live in one of the units in the house.
Great, thank you.
Hopefully that answers your question. You know where to find us, Hope, if you need anything further, or just submit another one. But thanks for the question. That's great. So Philip, there's a lot of moving parts, that go into this, and a lot of people don't understand the relationship of even realtors, and who's representing whom, and why you maybe need each one of these professionals. And so, briefly, can you talk about what the differences are on your side between like a mortgage broker, a mortgage banker? Why should someone pick one or the other?
Sure. So there's a number of different lending institutions out there. You have depository banks. You have the big depository banks, the Bank of America's, the Chases and Wells. They typically are kind of a big entity, a little bit slower on closing loans, have a little bit more arduous guidelines. We call them overlays in the industry. An overlay would be a company policy. So the guideline says you can go down to a credit score of XYZ. A big bank may put in other rules associated with that. There are two types of mortgage banks. There's a correspondence lender and a direct lender. A correspondent lender is underwriting files based upon the guidelines of their investors. A direct lender, like Movement Mortgage, is underwriting files to the guidelines. Now, we could choose to put overlays on their company policies. Generally speaking, we don't have any company policies. So we control our own destiny 100% of the way. So it's our overlays with respect to the guidelines. Typically, the depository bank, the mortgage bank, either the correspondent lender or the direct lender, are actually controlling their own destiny. It's being underwritten by our own team. It's being processed by our own team. The other entity you mentioned is a mortgage broker. A mortgage broker is out shopping to potentially find you the best rate or the best investor for your unique situation. Unfortunately, they don't control any aspect of the process whatsoever. Typically, what we see in the industry, they're taking at least 30 days and probably more typical like 45 to 60 days.
Wow. Okay. Well, that really helps. And we know that some of the direct lenders, especially the bigger ones, are taking a little bit longer than that, right?
Right. Well, the depository banks are taking much longer to do that.
Right.
We call our process backward processing. We actually process a file totally different than most other lenders. When we get a file in and we're under contract, irrespective if we've actually had them underwritten approved or not, the loan goes from myself, the loan officer, and my assistant directly to the underwriter. Our corporate standard is within 6 hours. When you look at the traditional lending institutions, usually the underwriter doesn't see the file anywhere from the 14th to the 18th day.
Wow.
So if there's a problem with the file, it's so far down the path. Usually third-party financing has already expired at that point in time,
Right.
and so forth.
Okay, we got a couple of questions. First
Great.
one was about time frame. How long, once they find a house, how long does it take for them usually to get through the process of closing on the lending side?
Sure. So in our case, we can do it as fast as 10 days. We've done it in 10 days. I would say as a standard, we're typically suggesting to write a contract within 15 to 21 days. Most lenders are taking at least 30 days.
Okay. And we have
Great.
one more actually. It says, I understand you qualify the buyer before they go out and search for a home. Can you explain that?
Sure. So we talked about underwriting. Ultimately, the only person who can actually say you have a good loan or a bad loan is the underwriter themselves. So pretty much 99% of all lenders won't send a file to the underwriter until you have a property in hand. So when we submit a file to our underwriting team, it's going through underwriting to make sure it's consistent with all the guidelines, and then our processing team, after the underwriter reviews it, actually is running what they call CAVERs, going to data verify to make sure that there's not something that we were unaware of. It polls every county database to see if there's a foreclosure that may not appear on the credit report, anything of that nature. So we're eliminating all the things that have tendencies to bite us when we're trying to do a loan the traditional way.
Okay, and we got one more.
Great.
From Russell. He says, I'm thinking of
Hey,
selling
Russell.
my property, wondering if including my children would increase the value.
Well, I know Russell, and I know Russell's kids, so maybe, absolutely. But hey, Russell, thanks for joining us. Appreciate the question, and I hope all your construction is going well out there. But hey, so that brings us to a great point here with the moving parts and all of the things that go into it. So briefly, before we're out of time here, I just really wanted to kind of go through a list of kind of where we go in the transaction and where the lender's involved. And so I'm going to kind of read a couple of things here from the screen just to keep us on track here. But one of the things that we do a little bit different is we make sure that we try to sit down with our buyers really early in the process, and we prefer to bring them in here to the office because we can go through a lot more material. We can maybe bring Philip in to that meeting at one point so that he can talk about the lending process and what exactly goes on, much like we've done here today, and educate you so to make sure that you're really truly ready to go out there and buy and make an educated decision. And it's really important that you do make an educated decision about your lender, because we've already talked about it's going to affect you when those sellers are looking at your loan and the loan company. They're going to consider that when they decide whether to accept your offer or not. So having that competitive advantages that we've already talked about are exceedingly important. And then after we've done that initial meeting, of course, we'll set up searches, and you'll do your formal loan application. You get pre-qualified or pre-approved. Pre-qualified first, pre-approved. We'll get that letter. You'll get the loan estimate, and then we'll really go hard at looking for that home. And while that's going on, that's where you're going to continue through underwriting, right?
Sure, we're going to continue working with the file. Once we have all the documents, while they're looking for homes, we'll be underwriting them in advance. I do want to make a point, because you make a really good point. There's lots of great lenders out there. And we've put together a spreadsheet that we've given to real estate agents of questions that you should ask when the client says, I already have a lender, right? One of the first questions should be asked, is your lender available on weekends and weeknights to speak to the seller? Real estate is typically still done on weekends in today's marketplace, and we don't see that changing quite a bit in the Dallas-Fort Worth area. Typically, you're making offers on Fridays and Saturdays, and they're accepting offers by Sunday night at 5 o'clock. If your lender cannot speak to the seller, you're in a competitive disadvantage.
Big advantage.
And if it's a lender that has a bad reputation, it's not a local lender, you're really in a significantly disadvantage. And so your loan, your offer itself may not be accepted. So having the right lender, albeit Movement Mortgage or any of the other full service local lenders, is going to be important to you of having your offer accepted.
Well, and it's always great to be able to walk down the hall or drive down the street and walk into somebody's office and be able to say, hey, where are we at? And to bring in your documents, do whatever we need to do to make sure we're moving down that process. So that obviously brings to the next step, which is after we've found that home, we're going to submit that offer. We're going to make sure that Philip or whoever our mortgage person is going to contact that seller immediately and make sure they understand the strength of the buyer and the strength of the offer. Hopefully that seller is going to then accept that offer, and then we're going to send that contract to you guys, and then as well as to the title company, and y'all are going to continue to work on it. And at that point, that's where we're talking about possible rate locks, right?
Right. Yes. In today's market, locking right away is probably the most important thing to do, because we're in a rising interest rate market. Over the past really 2 years, it wasn't as necessary to lock. Rates were kind of going up and down slightly, and sometimes you could seize the moment and get a better rate if you waited a week or something of that nature. Right now, rates have pretty much been going up almost daily. So you really, as soon as you find a property, our advice is lock the loan right away.
Okay. And so as the lender and the title company are working that file, the buyer is going to order the inspection. Of course, we'll help you finding or providing you at least a list of inspectors that will help you get that done. We're seeing a much shorter time frame on that now. Somewhere in between 5 and 7 days typically is what's in the contracts, and so we have to move really quickly. As we get any potential repairs negotiated, we're going to keep the lender informed on that so that we can order appraisal. So let's talk real brief about the appraisal process and what happens and why it's important to get that ordered early.
Sure. The appraisals have been taking longer than usual. We've got a great, what they call an AMC, appraisal management company. Since the debacle in 2008, new laws got put in place that basically all lenders have AMCs. We, as an individual lender or loan officer, can't talk directly to the appraiser. We can't pick the appraiser that we want to have picked. So we're trying to get what I'm looking for, an appraiser that you can't influence on the value and so forth. The key thing on an appraisal would be it's an opinion of value. So appraisers have significant latitude of determining the value of the house. Now, to the advantage of the appraiser, they're actually presented a copy of the contract. So they already know what the purchase price of the contract is, and they're going to find comparables out there to see if they can meet value, exceed value, or get us as close as possible there. If we don't meet value, there is an opportunity to basically challenge the appraisal. It's usually not very successful unless there's an error. So you want to get that done as quickly as possible in case there has to be some further negotiations based upon the appraised value versus the contract price.
Well, and this is an area that we've seen where it really makes a difference, and one of the reasons why I came into this business and it's why Stacy's been in it for 13 years, is because we really felt like we could help people in this area, and the relationship that the client has with the realtor, as well as the realtor to realtor, being able to communicate that process and where we are and understanding what's negotiable and what's not and what needs to happen next. So like the appraisal, if they're holding up the appraisal because of repairs, they're maybe holding up the deal and jeopardizing the entire deal.
Right.
And so if we can communicate well about that, then we can move forward much quicker, and the sellers need to understand that as well. And so when we're sitting on the selling side, we have to educate the sellers about that. Maybe talk them down off the ledge a little bit. That's one of the things we do quite often, be that third party, a 10,000 foot view. But after the appraisal's done and the lender examines that for acceptance, any lender required repairs are going to be done. We can talk about that as well. But mostly those are going to be, what do you typically see? Roof, foundation, anything major is what you're going to see coming from the lenders. But yeah, especially with the VA, because VA appraisal process is a little different.
Yeah, VAs and FHA theoretically don't want to see bare wood. They don't want to see cracked windows and so forth. Where a conventional loan, they don't care as much. Right. So it's important to make sure the house is in the right condition before the appraiser goes out, so that they don't flag it and have to go out and make a second trip and cost to borrow additional money and so forth.
Okay. Well, and then after we get through that, the lender's going to prepare all the closing disclosures, documents. We're going to get that all over to the title company. The buyer's going to need to bring their ID. They're going to need to bring either a cashier's check, or they're going to need to wire funds to the title company to get closed. Now, this brings up a really interesting thing that's been happening recently, is we're seeing a lot of wire fraud going on. Somehow these hackers are, which hackers seem to be in the media a lot lately, hackers are getting access at some point and finding out that there's a loan being generated or a transaction being generated, and they're emailing and saying, hey, send your funds here. Here are the wiring instructions. So For any of you out there who are in the process or going to be in the process, we just want to make sure that we make this a point of emphasis. Verify verbally with your title company at the physical location on a call you originate any wiring instructions, or just go old school and go cashier's check, either one. And then of course you can bring a personal check for things under $1,000 and that kind of thing. And then after we get that, the lender's either going to pre-wire. I know that's one of the things we love about movement is a lot of times we're funding at the table.
Yeah, we call it table funding. We're one of the few lenders that table fund. So once both parties signed, provided there was no closing or funding condition, which would be a rarity, then the client owns the house right there and then. They don't have to wait the 2 hours for getting what they call a funding authorization.
So that's a difference we see with a lot of banks where they are holding that up maybe a little bit. And it's always nice to be able to hand over the keys right away. And I know you're excited about your new home and you want to do that. Obviously, that pertains to the terms of the contract if there's a lease back or whatever. So with that said, let's kind of wrap it up. Was there any other questions that came in?
Nothing.
All right. Well, we want to thank everybody for their attention. We do want to give you a couple of little takeaways. As we've said, there's a lot of moving parts. So having knowledgeable professionals to help consult you through this process are extremely important. We want to start that planning process as early. We want to be intentional. We want to know what you have and what you're qualified for before we walk into a home, because we are in such a competitive market. It doesn't do much good for you to get excited about a house and then we can't make the deal go through. The second takeaway I want to say is just always be open to advice. I mean, we're very, should we say blunt? We're very blunt, straightforward. We're going to tell you what you need to know. It may not always be something you like, but it's going to be because it's important to you. But advice is kind of like going to the doctor and getting medicine. It only works, if you take it as prescribed. So, everything we provide you, everything our duty, both of us, our duty is a fiduciary responsibility to give you the best information possible so that you can make the best decision. And that's what we're here to do. So if you like this video, if you have other questions, we're going to continue to pull questions in. Just hit us on Facebook. Do you want to mention you have a specific website, right?
Yeah, movement.com, and you can search up my name, Philip, which is 1 L, and the last name is Artt, A-R-T-T.
1 L and 2 T's.
Yep.
So reach out to Philip if you want to get pre-qualified, pre-approved, and walk through that process, or just learn anything else about what should come next. Obviously, give us a call or text us. Hit us on Facebook. We're at the Reynolds Home Team. We'll be launching a new website here really shortly, so to give you even more data. So thanks for your time, and we really appreciate it. Have a great day.